Hey, this is Akhil from our mortgage broker, and welcome to another edition of Mortgage Updates with myself, Akhil, and my colleague Mitesh here from our mortgage broker. What we do on this channel, if you're watching us on Facebook, YouTube, is answer anybody's questions about mortgages, property finance, and currently giving you an update on how we're finding the market, the trends we're seeing from a client's perspective, trends we're seeing from a lender perspective, and who better to have answer your questions than none other than Mitesh Manek from our mortgage broker. So today we're going to be talking about how do I raise capital for my next buy-to-let purchase. This is a frequently asked question and something that we're finding quite easy to find solutions for, I would say. Mitesh, do you agree?
I agree, yes.
And what we're going to do shortly is provide a typical case study, a real life example of the question and scenario that comes across and how Mitesh is able to provide further solutions to meeting your expectations on, for example, your buy-to-let purchase. So for those of you that are joining us for the very first time, as I said, my name is Akhil from our mortgage broker. We're a specialist mortgage and finance brokerage based in Berkshire, but supporting clients and adding value and finding solutions for all types of property owners. So whether you're a first-time homeowner, a first-time landlord, or a seasoned property investor, we would like to be contacted or be in your first minds for any solution that we can hopefully help you and support you grow your portfolio or help you get on your journey for your first onward purchase. So a quick update on the housing market. Today's the Friday, the 11th of November, 2022. We don't want to dwell too much on the past, I should say. We've got a change in government. It all looks very positive in terms of stability of the money market, the interest rate market with the mortgage side of it. We're seeing a lot of interest rates coming down. Base rate was predicted to hit about 6% only 2 or 3 weeks ago. Bank of England now suggesting topping out at about 4.75. Who knows where we're going to top out, but what we can quite confidently say at today's market is interest rates are coming down in terms of fixed rates. They're looking more and more appealing. Stress tests are also looking very much appealing because this confidence is growing now from a lender's perspective in terms of the money markets and also lenders catching up with the backlogs of underwriting deals. So it's we're in a fortunate position, I should say, that the knee-jerk reaction that we've seen over the last couple of weeks has been slowly being able to turn around and become more of a positive outlook on the housing market. And we certainly believe as specialist mortgage brokers that buy-to-let is certainly not dead. And we're going to give you reasons why we think buy-to-let is not dead, the reasons that you should consider, and how you can still make a good profit and become this a viable business in the forthcoming 2023 that we're entering. So enough of me, more about Mitesh, but we're now going to move over to the whiteboard and I'm going to talk to you about the case study. So should we go for it, Mitesh?
Yeah, sure. Why
Go
not?
for it. So we're going to go with the impression. This is my extreme guest here, Nicola Waterman. Was that her name from Countdown?
Carol Woodman.
Carol Waterman, there we go. So this is Carol Waterman, more of a beautiful image of Carol, but some of you agree or maybe you disagree, but leave your comments below. We'd love to hear more from you guys. So the scenario is this. I've got a Mr. and Mrs. They both earn £60,000 each. They're both employed. They've got 2 young children who are still go to school. They have 10,000 outstanding in credit card balances. And they own their current home. Their home is valued at 800,000. And they've got a mortgage of 400,000 outstanding. They're still tied into their fixed rate mortgage with their high street lender, and they're getting a great rate of 1.5%. Don't we wish those 1.5% rates still available? I know I do, and I'm sure you do as well. But unfortunately, they're not longer available at the moment, but never say never, as we always say. So currently tied in with their high street with a rate of 1.5%, and they've still got 2 more years remaining on their mortgage product. In the background, they own 5 other buy-to-let investment properties, and they're roughly leveraged up to about 60% on each of the properties in the background. The scenario is this. They've contacted you to ask you, they're looking to raise £100,000 to purchase their next buy-to-let. Unfortunately, they don't have that liquid cash available, but they found a great deal in terms of cash flowing investment property in a great area, great location, and it's a viable interest that they want to add to their ever growing portfolio in the background. So what we want to know is, as homeowners with 50% loan to value on their current main residence, being a portfolio landlord in the background with 5 buy-to-lets, averaged about 60% in the background, and they're looking now to raise 100,000 towards their 25% deposit for their new purchase. Could you suggest some solutions and some options for the clients to consider, and talk us through your process and what you would suggest as an advisor?
Sure, great, excellent. So this is a typical scenario that we face all the time, Akhil. So on a regular basis, this is a question that you get asked all the time. How do I raise extra cash? I'm locked in my current deal. I need to buy my next purchase. What do I do? Where do I raise the cash from? So I'll go through some different options as an advisor. Technically, we should really be exploring all these options before we go ahead and advise the client in terms of the most suitable option. Okay. So what we know at the moment is that the property is worth 800K at the moment. Okay. So if I draw a line here, that's a high street lender, and what we would say is that they have a first charge on there. So they have a charge on this asset, the only lender on the house that's got a charge on the asset, and we're saying that the outstanding balance is 400K, and it's a capital repayment mortgage, which means they're paying capital interest. So that's basically what's happening. Now, with regards to we basically generally say to our clients is that you have 50% equity remaining on the property. So the way to work that out is your balance, which is 40,000, divided by 800,000 times 100 will give you 50% what we call loan to value. Loan against the value of the property. There's 50% remaining on, sorry, 50% lent against it. So there's 50% remaining because the value of the property is 800. So 50% borrowed, 50% remaining on there. So that's the bit that we're focusing on. So if I take the red pen, I'm making more clear here. So we have basically 50% equity on the property. Now, we mentioned the fact that the client has a joint income of £120,000 and the only debt they have is a £10,000 credit card bill, which means they should have surplus disposable income. However, we do know that there's a cracking deal of 1.5% that they have with the existing lender. Now, the first thing to understand is if we decided to go back to the high street lender as a first option and see whether there's any room for the client to borrow additional monies on top here with the existing lender for the 100K. So that is the first option you want to consider. Why? Because it's a high street lender, there's a very good chance that the lender can raise you the extra cash, which means it'll be additional borrowing with the same lender, but it'll be a different rate on here. We don't know what the rate is, but it'll be a different rate. So that's the first option you want to consider. In my opinion, that may end up being the cheapest option because they already have your personal information. Obviously, you have to provide all the income information and all that. Sometimes the drawback you find is that depending on how busy the lender is, it could take weeks sometimes to get a decision. And sometimes brokers cannot do the transaction. So it's very important that our viewers understand that. Sometimes a broker may not be able to do that transaction because for additional borrowing, that high street lender may come and say the client needs to call us directly or the customer needs to call us directly, which means the broker then cannot assist in this transaction. So I've faced those scenarios as well. So it's important to understand that. If the broker can, that's fine. The broker will do the research. So in my situation, I had a similar scenario, did the research, and I found that the lender was not able to lend 100,000. So obviously, the most obvious option is gone out the window. So what do we do next? So the next option was to understand whether it's worth us doing a £500,000 remortgage and going to a next lender and doing a remortgage and raising extra cash. Because remember, it'll be one deal, one monthly payment, depending on how many terms or how many years are remaining on the term of the mortgage, and we'll assess it accordingly. And that will be a standard remortgage transaction with capital raising. Now, the problem we have with that solution is that the client will face a penalty for exiting the deal early. Now, if they have a couple of years remaining in this scenario, my client will face a 2% penalty.
Right.
which is £8,000. Now, what I'd have to do is research the market, understand who is the best lender for the client to remortgage out, and whether it's a good solution for the client to pay the penalty and then get a new mortgage of 500,000, 400 plus 100 on a new rate, and that new rate potentially might be a fixed rate. However, it needs to make common sense and also at the same time we need to make sure it's the right solution for the client, because there's a bill of £8,000 to pay and the new rate might be in the current times 5+% on a fixed rate. So there's a massive difference there already in interest rate on day one when the deal completes. Remember, they've got still 2 years remaining. So you don't ask yourself the question, is it really worth doing that? Okay. So that would be your next option to consider. Alongside that, there's another option you have to consider. And you must do that because you have to then look at the option of understanding whether a second charge proposition works out better for the client. Now, this is a concept where a lot of clients may not understand. But what that means is that you've got a new lender coming and lending you £100,000 on top of the first charge lender.
Yeah.
Now, you compare the rates and see if it's feasible. If it's feasible, compare the rates. Remember, bulk of your interest is on 1.5%, and then the new interest here could be, let's say, anything from 7+, hypothetically speaking, and then you sort of work out and see which option works out best. Now, you compare a £500,000 remortgage on the new rate, let's say 7.25%, or a 5-year fixed rate, if that's what the client wants. Work the maths out and see whether it's worth paying the 8% penalty and the interest loss for the 2 years against the idea of keeping the existing mortgage and then just raising the cash with the view, it's important, with the view further down the road within the 5-year period for the client to be able to either clear that debt because the NAV bonus is coming through, or doing a remortgage when this deal comes up for renewal.
Right.
This is a little research we'd have to do before we then start recommending to the client the real option for them that's available.
So just really touch on that. Sure. Thank you for that. So in summary, what we want to do here is the scenario is the client owns a remain residence with 50% outstanding and 50% borrowed on their main residence. They want to raise 100,000 for a new onward purchase. The 3 options that Mitesh has just mentioned there. The first one is providing the client with a further 100,000 borrowing on their main residence, as long as it's affordable based on their income and expenditure with the same lender. So raising the current mortgage from 400,000 to 500,000 to make the new onward purchase viable. So the first option is the further advance.
But the 100,000 will be obviously a different rate.
Yes. So that additional borrowing, which may then lie into a new product, additional borrowing or a second product with that same lender. Every lender's got their own ways and nuances how to proceed but that's how the premise works.
Yeah.
The second option you suggested was taking that and moving it from lender A to lender B.
Yeah, that's it.
Okay. Now, what happens there is with lender A to lender B is you mentioned quite rightly if they break that kind of deal, which has still 2 years remaining, they will incur that penalty. In this case, was 2%. So there's an 8,000 penalty to refinance to a new lender in order to raise that mortgage. And unfortunately, as you quite rightly said, the rate of 1.5 will then be removed, and you're probably heading towards a 5+ rate at the moment if you wanted a 2-year fix, for example. The third suggestion you made was applying for a second charge mortgage on your current home. Second charge simply means you've got your current mortgage of 4,000 with lender A. You're now applying for a second charge mortgage with lender B, who comes behind and sits as a second charge on your main residence. Subject to affordability in all cases, because it's a regulated loan and it's on your main residence. They could potentially offer you that further borrowing on a second charge basis based on affordability. But at a higher rate because it's a second charge loan, albeit it could be for a shorter period. So they're the 3 solutions you mentioned about raising capital on your main residence.
And there's a 4th solution as well.
Go ahead.
So if we find in this exercise that the goal is 100K,
Yeah.
and we end up finding out whichever option you go with, that you can only raise 50K. We are short by 50K.
Yeah.
Yeah. Now, we mentioned in the scenario that the client had buy-to-let properties in the background.
Yeah.
So the same exercise can be looked upon on the buy-to-let side, and because there's equity in the property of 40% per property,
Yeah.
there's a very good chance that between those properties, or B11, that we can raise the shortfall of 50K, and that way you then get your 50, 50, 100,000.
Amazing. So in short, there are tons of options available to this client simply because they're quite low. They're only 50% geared against their main residence. They've got, as I said, they've got a good salary between them. The overheads are low.
Yeah.
They've also got a great portfolio in the background, which they can potentially raise capital against, bearing in mind the stress test and the rental income that they receive. So for those of you that are looking to raise capital for onward purchases going forward, please do contact Mitesh on the details below in the caption, where we can look at viable options for you to raise capital. If you haven't got any liquid cash viably available, what we would strongly suggest is contact the likes of Mitesh and our mortgage broker to talk through your current portfolio, understanding your income, understanding your affordability and your expenses, and let us do that legwork. You know, you're busy in your day job. We want to take that time and stress away from you for us to do that research. And as Mitesh quite rightly said, there are tons of options that are viable. It's just about understanding the numbers and ultimately where you want to be. So Mitesh, thank you so much for that valuable information. If anybody has any questions, please drop the questions below, and Mitesh will be on the first, within the minutes, will contact you either via email or telephone. Any questions or feedback on this video, if you want more videos like this, drop us a comment below and we'll do our best to answer for you. Again, my name is Akhil from our mortgage broker. This is Mitesh, the specialist mortgage broker here at OMB. Any questions, drop them below. And Mitesh, once again, thank you so much for your time.
Thank you.